Welcome to The Economist in Your Ear podcast. So here's something to chew on. The stock market's been, well, soaring, hasn't it? Lots of AI excitement, growth forecasts for 2025 look decent enough. But are we maybe overlooking some deeper structural economic damage, the kind that's already sort of baked in and might be way harder to reverse than anyone's really admitting? That's the core tension we're digging into today. We're looking hard in this argument that America's fortress economy, built more and more on these really high tariffs and frankly, extreme immigration controls, is starting to cost the country big time. Because right now, you've got this totally split picture, don't you? Market euphoria, valuations through the roof, set against this, like quiet buildup of economic friction, sand in the gears, maybe.
Exactly. And our job here isn't just to summarize, markets are resilient, everything's okay. We really need to unpack the assumptions behind that feeling. Is everything really fine? We need to bring in the evidence that suggests these current pain points. They're probably being understated, especially when you look at the slow burn effect, the loss of dynamism. These policy choices, they're creating structural issues. They might not show up dramatically in the, say, Q3 earnings reports, but they absolutely can limit our potential down the line.
Okay, let's unpack that. Starting with that immediate paradox you mentioned, the market euphoria. After what some analysts were calling Liberation Day back in April, when those big new tariffs really kicked in, the initial economic panic seemed, well, totally overblown.
Oh, it certainly looked that way in the short term. Markets just swung straight into optimism. I mean, the S&P 500 up a huge 40% since that low point in April. And what's maybe even more striking is the valuation. We're talking over 40 times cyclically adjusted earnings. It's getting close to dot-com boom levels. It basically means the market is incredibly optimistic, pricing in like decades of amazing future growth.
And part of that initial relief, I guess, came from the customs revenue data itself. Early numbers seem to suggest the average tariff rate was only hitting around 11% through the summer, not that scary 28% number people worried about initially. Sounded kind of manageable.
Right, but that's the first big assumption we need to challenge. That market boom, yes, it's impressive, but it's heavily fueled by AI optimism, isn't it? It doesn't automatically mean the whole economy is healthy. You can absolutely have equity surges, especially driven by tech excitement, existing alongside growing macro fragility. A high stock multiple doesn't magically protect you from terms of trade shock or, bad policy choices.
So the market is essentially betting that the tech story is so strong, it can just power through whatever friction the trade policy creates. That feels like a really big gamble if the underlying policies are actually corrosive.
It is a big gamble. And remember that comforting average tariff, only 11% figure from customs data. That simple calculation, it's likely too low. It misses key things like substitution effects, companies finding ways around it, and various exemptions, model-based estimates. And the budget lab at Yale pointed this out. They put the effective rate quite a bit higher. You can't just look at one simple snapshot.
Okay, shifting gears a bit, let's talk about a really immediate, tangible cost: inflation. The source material makes it pretty clear the tariffs we already have are starting to pinch consumers.
They definitely are. The data suggests tariffs are currently adding about 0.3 percentage points to overall consumer prices. And crucially, this probably isn't the end of it. That number is expected to rise. It's likely a peak around the turn of the year, maybe pushing the underlying consumer price index, the core rate the Fed really watches, maybe up close to 3.5%.
Why the delay, though? Why doesn't the full inflationary hit land the second the tariff is imposed?
Well, economists, including folks at Goldman Sachs, they've shown there's a clear lag effect. Basically, the longer a tariff is in place, the more completely it gets passed through to consumers. Initially, importers might absorb some cost. Maybe they try to squeeze their suppliers or shuffle components around, but eventually they stop eating those costs. And when they finally do raise prices, guess what? Domestic producers who are now sheltered from that cheaper foreign competition, they often feel like they can raise their prices too.
So that delay actually sets up potentially a bigger, more concentrated price surge later on. We're already seeing some of that. Prices for key imports, clothes, electronics, appliances starting to jump above their normal trend lines.
Exactly. We've seen those specific categories surge already. And this links straight back to policy risks, both political and monetary. Sticky CPI. That has huge consequences. You look at polling from YouGov, Americans already disapprove of how inflation's being handled by a big margin, like 28 points. And the risk for the Fed, if inflation stays stubbornly high because of trade policy, something outside their control, it really ties their hands, right? It makes it much harder for them to cut rates, which in turn threatens those super high stock market valuations we just talked about.
Okay, so that's the tariff inflation story. Now let's pivot to what you call the drawbridge effect. the structural shock from clamping down on migration. This seems huge and maybe not fully appreciated by everyone.
It's enormous, and it's policy-driven on a scale we haven't seen in ages. Just for context, annual net migration into the U.S., it averaged about 1 million people a year from 2000 to 2020. It even hit 2.5 million under the previous administration. Now, projections suggest net migration could fall to 0 or even go negative in 2025. That hasn't happened since the Great Depression. It's a massive swing.
And critically, this isn't just about the southern border narrative, is it? The policies reach right into high-skilled talent pools, too. Like that new, what was it, $100,000 fee for an H-1B visa for new petitions from overseas starting this past September? That's an incredible barrier.
It's a staggering fee. And beyond the cost, think about the signal it sends. It basically tells the world's best and brightest that, well, maybe they aren't the top priority anymore. And this hurts the economy in 2 distinct ways. First, there's the near-term pain. Sectors already short on labor, think construction, healthcare, food service, they feel the squeeze immediately. Labor gets even tighter.
Right. But the long-term impact, the hit to dynamism,
Yeah.
that's the real kicker, isn't it? It feels like you're starving the engine of future growth.
Absolutely. The structural cost is immense and maybe harder to see day to day. But look at the studies. The average skilled migrant, someone with a graduate degree, often in science or tech, they contribute a net positive of about $1.8 million to the Treasury over their lifetime. And even though skilled migrants are only about 5% of the labor force, they generate something like 10% of total labor earnings. The productivity punchline is even more dramatic. One key study estimated that somewhere between 30% and 50% of American productivity gains between 1990 and 2010 came from skilled migration.
Wow. So when you effectively shut the door or make it much harder for that mobile, high-impact talent to come in, you're not just missing out on workers today. You're actively sacrificing a core ingredient of what made the U.S. economy so exceptionally dynamic for decades.
Yeah.
And that cost doesn't just disappear. It compounds, right? Year after year.
Exactly. It's a loss of institutional knowledge, of innovation potential. It's almost impossible to put a precise number on it, and it's incredibly hard to get back once those talented people decide to build their futures and their companies somewhere else.
Okay, let's broaden out again to the geopolitical angle. There's this risk of isolation, isn't there? The U.S. might be building higher walls, but the global economy is huge. America only accounts for about, 15% of global demand for imported goods?
Yeah, that 15% figure is really important. The risk isn't that America suddenly becomes irrelevant overnight. It's that the rest of the world finds ways to, integrate without it. And you're already seeing real conversations happening, closer ties between, say, the European Union and the CPTPP, that big Pacific trade bloc, including places like Canada and Japan. Mark Carney, Canada's PM, specifically mentioned the growing need for these kinds of non-U.S.-centric partnerships.
So if the U.S. puts up barriers, it just incentivizes everyone else to strengthen trade routes that bypass America, making the U.S. relatively less central, less competitive over time. And we're seeing some signs investors are noticing this. You mentioned the dollar.
That's right. The broad dollar index, the DXY, it's down quite a bit, roughly 9% so far this year. That reflects, partly at least, rising concern about U.S. policy risk and maybe a less certain growth outlook compared to other parts of the world.
Now, the source material mentions that apart from China, there hasn't been widespread formal tariff retaliation against the U.S. Does that mean America has basically gotten away with its protectionist turn, at least for now?
I think just looking at formal tit-for-tat tariffs is a really dangerous way to measure the response. The idea that few countries retaliated seriously understates the real pushback. It misses all the non-tariff stuff, which is often slower, quieter, but much more corrosive in the long run. Partners respond to other ways through government procurement rules that favor domestic firms, through new product standards or licensing requirements that subtly disadvantage U.S. goods. And look at China's countermoves. They aren't primarily using simple tariffs. They're using export controls, messing with supply chains strategically. That's the stuff that keeps jolting U.S. markets. That quiet friction, that's the real retaliation, and it's ongoing.
Got it. So the bottom line here is if the U.S. stays on this path, high tariffs, less open to global talent, the gap in relative competitiveness is just going to widen as allies and rivals find smarter, more efficient ways to build supply chains that don't rely so heavily on the U.S.
Absolutely. You put it well earlier. These policies are actively sanding the gears of the economy. You're swapping speed and global competitiveness for this cumulative friction, this pain that becomes really hard to undo. And the core cost at the end of the day is lost dynamism. slower productivity growth because you have weaker migration flows, and less competitive pressure because you've dampened trade.
Okay, this is really helpful context. So for you, the listener, who wants to track this thesis to see if these tariffs and the migration clampdown are really starting to bite, where it counts, what are the specific, actionable things you should be watching over the next, say, few quarters?
Yeah, we can boil it down to 4 key indicators to keep an eye on. First, watch core goods CPI versus services inflation, excluding shelter. Monitor that over Q4 and into Q1 next year. If you see core goods inflation staying firm or even picking up again because of that tariff pass-through we talked about, while services inflation, ex-shelter, keeps slowing, that would confirm that this policy friction is a key reason overall inflation is staying sticky.
Makes sense. And then tracking the talent drain. We talked about H-1Bs.
Right. For that, you need to look at the leading indicators. Keep an eye on the H-1B visa and OPT pipelines. OPT is that optional practical training program for foreign students after they graduate. Watch those numbers, plus general foreign student enrollment figures, and maybe even things like time to hire metrics in key STEM fields. If those indicators really sag through the spring university admissions and corporate hiring cycles, that's a strong sign the talent drain is becoming a deeper, more structural problem.
Okay. And what about that broader investor sentiment, the global view?
That's the third point. You want to monitor the DXY, the broad dollar index, and also the term premium in U.S. Treasury bonds. If you see the dollar consistently weak or weakening further, and if the risk premium investors' demand to hold long-term U.S. debt starts to rise, that would suggest global investors are genuinely getting more nervous and starting to re-rate U.S. policy risk downwards, fearing maybe longer-term instability or slower growth.
And finally, that sort of quiet, under-the-radar geopolitical friction.
Yeah. Number 4 is to look for trade partner measures. Specifically, keep an eye out for headlines about those subtle non-tariff barriers, maybe new standards or procurement shifts. And definitely watch for any repeated jolts from China announcing export controls that target specific U.S. industries. Those are the real indicators of that slow-moving but significant geopolitical friction building up.
It really paints a picture, doesn't it? Where America, which for so long was seen as the shining city on a hill, a beacon for talent and trade, risks turning into more of an isolated fortress. And you really have to wonder, how quickly can that trust, that faith from global talent and trade partners that they are welcome, how quickly can that erode? And maybe more importantly, how long does it take to rebuild those vital connections once they're damaged or lost? That feels like a cost you just can't easily quantify. Thanks for listening. Follow us for daily insights into world affairs, and don't forget to like, comment, and share.